a fund which has been talk of the town for the last 1 year. Yes, I'm referring to Parag Parikh Flexi Cap Fund. In this video, let us have a detailed analysis on the various parameters for this fund and why it is attracting so many new investors and how the fund size has grown to a whooping 1,15,000 crores. This fund house, which is very well known to follow the value investing principles, and the man behind the show, Mr. Rajiv Thakkar, has successfully given a tremendous CAGR of 19.72% since the inception of the fund in the year 2013. So in this video, we will not just be understanding the technical factors and ratios, but also the psychology behind the fund house and the man, Mr. Thakkar itself. Let's understand what is a Flexi Cap Fund. It is a type of mutual fund scheme in India which invests in all sorts of market capitalization, namely large, medium and small, without any restriction on allocation. This flexibility helps the fund manager to balance between growth and stability, which is very well reflected in the investment principles of this fund house, which is value investing. Now, let us understand all the technical ratios which are present in the updated fact sheet available on the AMC's website.
Now let us analyze the technical ratios of this fund with the help of this fact sheet. The fund is following the value investing principles, which says that buying stocks at less than its intrinsic value and holding it for a longer period of time. With a total AUM of 1,15,000 crore rupees, the fund has given a tremendous return of approximately 19.72% in its direct growth plan, which is higher than most of the other plans, and also beating its benchmark, which is Nifty 50 and Nifty 500. The fund is charging an expense ratio of approximately 0.63% in its direct growth plan, which can be considered to be reasonably lower side when compared to the other flexi cap funds of the same category. Now let us understand the quantitative indicators of this fund. First is the beta of the fund. In simple terms, beta indicates the percentage change in the fund in respect to the change in the market, usually considered Nifty 50. Having a beta lower than 1 indicates that the fund is less volatile than the market, although it puts a slight limitation on the rise, but it also safeguards from the downturn. Considering both the Indian and the US market to be overvalued in today's time, having a lower beta would definitely reduce the risk of fall in case of any major correction in the near future. The second most important factor is the standard deviation, which is a measure of volatility. It shows how much the fund has deviated from its average return over a period of time. Having a single digit of standard deviation of just 8.9% truly indicates the stability of the fund over the years and reflect the value investing approach of Mr. Thakkar. Now let us analyze the Sharpe ratio. It is a measure of risk adjusted return. It tells you how much extra return you are earning for a unit of risk you take. With a Sharpe ratio of 1.5, it can be indicated that having a Sharpe ratio of greater than 1 is considered to be good indicator, which is better than the other flexi-cap funds, mainly because of the lower standard deviation that the fund is able to maintain. Now let us quickly look at the entry and exit load. If above 10% of the holdings are redeemed within a period of 365 days, a 2% exit load would be applicable and 1% if redeemed within 730 days. This again indicates that the investor should remain invested for a very long period of time. Let us see the portfolio turnover. This parameter is considered to be very important for the funds that follow stability and value investing principle. This indicates how frequently the fund manager buys and sells securities in the portfolio during the year. A PTR of 100% indicates that the fund manager has replaced every single security in the portfolio during the year. A higher PTR indicates more churning in the portfolio. On the other hand, a lower PTR indicates stability, buy and hold style of investing, and ultimately resulting in lower transactional cost. There is a difference between portfolio turnover including and excluding equity arbitrage. Arbitrage means taking price advantage between the two markets. So fund, specifically equity fund, sometimes uses arbitrage position for short-term gains or hedging. These positions can artificially inflate the PTR because the arbitrage trades are frequent, even though the fund's core investment strategy may not be that active. So including arbitrage PTR looks very high, but it does not mean the fund manages is constantly reshuffling long-term holdings. When we exclude the arbitrage, we get the real turnover of the core equity portfolio, which makes a better sense of understanding that whether the fund manager is truly long-term or keeps changing his stock picks, which shows that the conviction and stability. Having a PTR of approximately 16% shows that the fund is not reshuffling its portfolio frequently and the core investment strategy still remains intact.
So, after going through all the analysis, it can be concluded that this fund is not about chasing every market move, but it is about conviction, stability, and long term wealth creation. So, for someone who follows stability and disciplined investing over speculation, this fund continues to be the most appropriate fund in the FlexiCap category. So, if you are an investor with a long term horizon of at least 5 years and believes in balanced growth and stability, then this fund could be a strong fit for your portfolio. Thanks for watching. Invest smartly and stay invested.